Yeah, this is an interesting one because we now talk about rolling once a month, and we're of course going to cover how you roll and what rolling futures is here in a second. But I like to put a different flavor on it every time, Pete, to get your thoughts and get more opinions out to the general public on rolling futures. Say I want to talk about why you might do it and really conclude at that point. But before we conclude there, Pete, maybe you can give people some insight into why rolling exists. Like, if I wanted to trade, say, the SPRE futures, the small metals, and it's like, oh, you guys are letting me trade gold and silver for a fraction of the cost. I can get that exposure direct to the commodity, all these nice pieces of being a futures contract, cheaper to trade and all these different things. Why do I have to roll it to begin with? Why can't I just have futures that exist forever? That's kind of like an oxymoron, isn't it?
Yeah, but it is probably the signal for my 30 plus years of trading and 10 years of being able to educate and share my thoughts about markets. It's probably the single most asked for questions. The paradox of why do I have to do this bit of housekeeping? And it's the nature of all the good things that come with futures, from everything. And it's funny, I was reaching out to somebody, and all futures are taxed at a blended rate of 60-40. And this is actually right around tax time. It's an interesting piece. But what that means is, rather than paying short-term capital gains, you get this blended long-term, short-term capital gains rate. And there's no holding period. You hold a trade for a second, a minute, or a year, same 60-40 blended rate. You get all these benefits. The leverage through span margining all comes from the fact that we're not trading ownership on an underlying. We're trading a contract for ownership somewhere down the road. But it's a contract, not the obligation for ownership. So with that, you get all these benefits that come with them, the span margining, all the other pieces. But it requires, so it's a contract for future delivery, not a spot one, not a traditional, T+1 stock trade. So with that comes this requirement that by definition, futures, a date in the future, it expires. So to maintain all the pluses that we get, we have this very simple monthly housekeeping job. What's nice is in our world, it happens twice a month. What I mean is all of our products, except our new crude oil product, expire on the third Friday, smallest crude on the second Friday. And it is as simple as literally, it's 2 clicks of the mouse and you're maintaining your exposure. And it's that simple. So all the benefits that come with it, this is the one thing we need to do in terms of housekeeping. It's just the nature of the way products are constructed. Ours are no different in terms of, ours are so different in so many ways. This one piece of mechanical housekeeping is something we need to do every month.
Yeah, it's almost like, oh, I want the efficiency of futures and the direct access of futures, but I don't want it to expire. And it's like, well, that's a different thing. And that's not a futures contract. Unfortunately, it's in the name that it is a futures contract. At some point, it has to expire there to the actual asset, which then costs more. But thankfully, just expires to cash. And yeah, I was just talking about this earlier today, Pete. The fact that it's almost overrated to actually own something when it comes to trading. Like with the small metals, just going back to that, it's like, oh man, like I think metals are going higher. And so I can go buy gold and silver, and it's going to be costly and it's going to be a pain in the neck to go actually get that commodity. Or I can just easily trade the futures. It costs less. It's very accessible here. And I make money as the price moves higher, the same way that if I owned the actual assets themselves. It's overrated, and it's just clunky to actually own these things when you're just talking about trading. But that being said, the only clunky part about futures is the roll. But like you said as well, Pete, very easy here. The smalls, except for small U.S. crude oil, which just launched here, all the rest of them, SM75, SPRE, everything else down the line, is expiring on Friday afternoon here. With that being said, it is Wednesday or even tomorrow or Friday morning or what have you. You'd do yourself a great service to roll that future here coming up to that third Friday. And that's just a matter of, Pete, selling your K21s if you're long, or buying your K21s if you're short, and then putting that same position on in M21, which now, as of this week, is the new active month. Like you said, Pete, it's in some places it's not even 2 clicks. It's 1 click. You just right click it, roll, and it's over with. It's really something that's become a lot easier. How did you used to roll stuff back in the olden times?
You know what? There was a section of the pit that was for the quote unquote back month. And it would get busy as we went towards this week of expiration. And honestly, expirations back in the pit days lasted 2 weeks. What I love about cash settled products now, they're really boiled down to 2 days. It's yesterday and today. Can you do it tomorrow, Friday? Absolutely. But 85% of the roll goes through in a very efficient, tight manner. So for those 2 weeks, you would either trade spreads as a package when orders come in, or you would leg them, which is meant you would buy the front and then try to sell the back for a little bit better. And it was a relatively convoluted and expensive way to maintain duration. So there was, as a local, there was a tradable opportunity in there. No tradable opportunity for us right now. That's not what we're looking for here. When we put strategy together and attached mechanics and management to that, nowhere in that said, and I want to get clever on that third Wednesday of the month because I'm going to pull out an extra $2 legging the spread. We don't do that. We roll, we maintain our strategy and our mechanics around our idea, not the idea of trying to make our housekeeping a little bit more clever. So it's as simple as that. And you know what I loved? What you hit on, Frankie, too, was this idea of efficiency in terms of the cap. Ownership is overrated. And I think what you mean by that is it's expensive to own things in the traditional equities world. We're all constrained except for a precious few, like Frank Caberna, who, again, being Beverlovian royalty, has billions of dollars in some vault somewhere that I will find. But we're all constrained by capital. So with that constraint, we want to be as efficient, because what does that do? That enhances our return on capital. And at the end of the day, we all want to make money. We want to mitigate our losses, but it's what we do with our capital, how we take X and make it X plus 20%, X plus 10%. That's the key. And if we could do that in a more efficient way with futures, that is such an important piece. And this is the key to doing it, maintaining that exposure and maintaining that duration.
Yeah, it's almost like, like I buy records and I tell myself they're an investment, but I buy them and I own them because they are cool to look at and play and listen to, have people over, you play a couple records, or you have a party and you maybe put together a little DJ set and everything else. But it's not like cool or fun to actually own bars of metal.
No,
or
but let me
barrels
ask you
of
this:
oil.
with your records, do you have a Beanie Baby for each record? So you've got
this is really good.
You've got like 2 investments working synergetically with one another.
I'm not even going to entertain that. What happens if you don't roll your futures, Pete? Thankfully, some futures they settle physically, and if you were using a futures contract to own some commodity and you had that efficient rate of not 50% or 100%, but like 10% is the capital requirement. When that physical asset shows up, now you're paying for all of it, and you don't want that physical asset a lot of times. Thankfully, the smalls, they don't expire to the physical asset. They settle to cash, Pete. So it's the same as, not that trading or investing is gambling, but it's the same as casino, where it's like, okay, expiration Friday, for all intents and purposes, the Super Bowl in this analogy happens on a Friday. I bet on the team that won. Okay, the money is in my account and the exposure is gone. And if I want to bet on the next Super Bowl, then I have to bet on the next Super Bowl. The same thing here. Like if you were long equity index futures, Friday expiration happens. If you made $200, the $200 is in your account. The only thing that stinks, Pete, is that exposure is gone. And I wanted to bring up a real scenario here, because this is one a lot of people have been getting behind for good reason, I think. A lot of people long the S2Y futures. Yes. 2-year yields very low, historically super depressed here. And this is one that if you let this settle to cash on Friday, no big deal, right? Like if you bought it at 150 and it expires at 160, you got the $10 in your account. But that lack of exposure, Pete, if we see a rise in yields next week or next month and you didn't roll that future, you're missing out on all of that upside that you wanted to get from the initial trade.
Absolutely. And that's, if in just to think about it simply, our strategy was that we've got a bias that short-term rates are incredibly low at 60 basis points. There's no arguing that point. So nowhere in that said that there's a clock running on this, and it happens to be the third Friday of the month. And if they don't rally by that, I don't want them anymore. Another reason why we take it out too, and you hit on a term that I think we can't overemphasize enough, and we sometimes kind of skip over, but moving to the next active month. As traders, we want liquidity. The bid offer spread is probably one of our greatest points of friction or cost in doing business. We want to stay where the market is the most liquid. And in most financial futures, like our futures or S&Ps or bonds, all that liquidity is in that first month. So I always get questions of, I really like this 2-year position. I think by the end of the year in December, 2-year rates are going to be back to 100 basis points. Great scenario. Again, you and I don't know where they're going to close, let alone where they're going to be at the end of the year. But so why don't I just go out and buy a D's future? And part of the reason we don't offer them is just because of the way financial futures are constructed. They're not very liquid markets that far out. Yep. And what you give away in liquidity and the ability to manage that position far exceeds what you get from not having to roll them. So we roll because it's part of the mechanics, and also because it keeps us in the most active month. Active month means liquidity.
That's exactly right, Pete. And I just had this conversation with a friend of mine, because he said that honestly, it's a good question. And a lot of people have it when they first get to futures, right, is like, well, if I think 2-year yields will move higher in the next 6 months, the remainder of 2021 here, why don't I just buy the D's right now and it'll just happen at some point? And here's why, because that's not the active month. And in financial products like this and equities and some other markets there, the liquidity isn't there. And so while that contract will probably move higher if 2-year rates do move higher, if that happens in June, you're going to have a hell of a time getting out of that December contract. Right. And so it is this scenario of like, I think it's going to happen over the next 6 months. But I have to stay in the active futures. Right now, it's a matter of being long the S2Y June 21. If you see that rise in June, you're going to be real happy that you were in those June futures, because you're going to be able to get out like that. It's going to be real easy because the liquidity will be focused in there. If it happens in July, you will have rolled to the July futures, as opposed to being in the December futures for the next 6 months, not having to roll. Sure, that's a nice plus. But if that rally happens next week or next month, you're going to be looking to sell into a market that is going to be very wide, and there's not going to be anyone in there trading. Right. And you and I both know the worst thing in the world is either having a market that's running in your favor or running against you that you can't get out of. And no one wants to be a part of that. So why do you roll futures? It's so that you stay in that active month and that you keep that exposure going. Worst case scenario in the smalls, they expire to cash, but that cash will not now move like your long futures or short futures would have if you rolled them.